Nancy Lazar is a global economist and co-founder of the Cornerstone Macro. Nancy, great to have you back with us here on the program.
Thanks a lot. Nice to see you.
Thanks, Nancy. When you look at this right now, how do we as investors try and assess watching the economic data improve with potential flare-ups in the virus? An administration says they don't want to close it back up again. I mean, is that all that matters here, whether or not it leads to deeper quarantine?
Well, so I would take a step back and say what really matters here, first and foremost, is all the policy that the Federal Reserve and fiscal authorities have put in place. In the United States, we have now monetary fiscal policy stimulus to the tune of 44% of U.S. GDP. Never have we seen anything so aggressive for U.S. economic activity. And importantly, that's been joined by the rest of the world. Eurozone stimulus is similarly also now up to about 44. That's monetary and fiscal. Japan has leapfrogged us both with their combination of monetary fiscal stimulus up to over 60% of GDP. So let's take a step back and understand the data are going to be volatile. There's going to be uncertainty because this is something we can't forecast, the COVID crisis. But what we do know, massive monetary policy and fiscal policy. Second, the economy is now opening up, so data are getting better. Third, the credit markets have healed dramatically, and you're seeing a positive impact from lower corporate bond yields and also lower mortgage rates. Let me stop. So I tend to take a little bit of a longer-term perspective, understanding that there's a lot of uncertainty right now, but still net would have confidence, particularly by watching what's going on in other parts of the world, that you are going to see the economy continue to grind higher.
Yesterday, we heard from Jay Powell that everything is hunky-dory in terms of the rate projections, but it seems like investors may not necessarily think that means that the economy is so hunky-dory. I mean, the fact that we have a big risk-off day right after Jay Powell cleared the the course here for no new higher rates, what does it tell us, Nancy?
Well, so first, the markets have obviously already had very, very big moves, much more so than probably anybody, certainly than I would have expected given the backdrop. So to have a down day as we're seeing today, again, that's out of my league. I tend to look at bigger trends. So no, I am not that disturbed by the news, by the sell-off in the markets today. The unemployment claims data continue to come down. We certainly see that in initial claims. Continued claims seem to have stabilized. Again, take a step back at the data. Car sales in May were up 40% month on month. Our daily consumer confidence survey as of today is up 15 points from where it was 10 days ago. So even though the virus is certainly still coming back to haunt certain parts of the country, consumers are getting more confident with our survey, daily survey, just got my reading this morning, up about 15 points. Auto production for the third quarter is on track to increase about 150%. Manufacturers were shut down in the second quarter. So we've already clearly seen a rebound in housing. You see that in mortgage apps. As I said, they're up about 70% from their low, back up to their 2019 highs. You've seen a total recovery in housing. Now we're getting manufacturing kicking in, probably more of the June, July data, with auto production scheduled to jump pretty significantly. So I would use these more as pauses in the market rather than get overly concerned that we're beginning another bear market.
When we look at the rebounds that have happened in these data you're pointing out, some of them have been just astonishing. We've talked here a good bit about the housing side of it. Now you start to see some more of the consumer numbers elsewhere pick up. As you mentioned here, the sentiment's definitely improving. At the end of this month, though, the unemployment additional payout, the $600 is expected to expire. We don't really know what's coming on the back of it yet. How does the rate of improvement in employment factor into the potential for those data rebounds to continue? Does it mean we need to get another fiscal bridge? Like, what's the rate of improvement for employment? Is it improving fast enough to where we don't need an extension of the fiscal policy?
So first, that $600 expires at the end of July, so we have almost 2 months of that left. And second, my colleague Andy LaPerriere does believe we're going to get some sort of a bridge, but potentially not as attractive as the $600 and maybe something more to encourage people to come back. So Andy does think we will see another bridge. And I would also say at the same time, along with potentially another bridge, you also are getting improvement in employment. We do think that we could see, just as we saw in May, as now basically the entire country has at least started to reopen, and by the end of the month is likely to be almost totally reopened. We do think as we go through the summer, we're going to see some continued very large increases in employment, and I'll be watching our daily consumer confidence. It's one of the reasons we rely so much on our confidence series. It's going to be very useful this summer as we potentially get hit again with or COVID cases remain high. What's going on in Washington from a fiscal policy perspective? How about uncertainty around the election? So our daily consumer confidence, I'll be watching very, very closely. And so far, it tells me the consumers are feeling pretty good. The level of consumer confidence today is nowhere near as low as it was in '09, which is striking given the severe hit we've taken to the economy in the second quarter. So yes, fiscal policy will matter. But we do expect a bridge, albeit potentially not as attractive. And I would argue you don't need it, given that the economy is now starting to heal and the lagged effects of all the other stimulus in the economy is still kicking in also.
Okay, and thanks for the clarification. July 31st, the $600 expires. When we look at the potential for the overall kind of nominal strength of the economy compared to pre-COVID, any idea where our current momentum will take us? 5% below where we were, 10%, right back at the same, something above it? I mean, it seems like at the one point the market was potentially trying to price something like that in, at least if you judge from the NASDAQ, that maybe we'd actually come out hotter than before. What's the percent that we'll get to relative to pre-COVID?
Well, I think by 2022, we'll probably be back to the 2019 peak. So it will take about 2 years before you can get the level of economic activity, GDP growth, back to the same level we were prior to the COVID. That's similar to what we did during the Great Recession in 2009, 2010. It took about 2 years to go back to that previous high in economic activity. Employment will probably be a little longer. The last 3 recoveries have all been jobless recoveries. That is now the trend. By that, I mean employment improves. It just lags GDP growth. And that was, again, very true the last recession. You had it was almost 4 years or over 4 years before you saw a new peak in payroll. And it could be that again today. But you do increase, on a more moderate. So it's kind of the new normal to have these slower rate of increases in employment relative to GDP. But yeah, we went down very far, very hard, very quickly, and it will take time to come out of the hole. But a recovery nonetheless. And I think that's what's more important. In that we're not going to have an L. We are going to have we think it's a V rebound. We see that in the data right now, but a wavy recovery because there is going to be a lot of volatility, particularly as we end the summer and move into the fall.
Okay, Nancy, great analysis and a good look forward here. I think an optimistic one that we should feel good about, even if it is wavy and takes a couple years to get back to where we were. We're on the right track. Nancy Lazar joining us, global economist at Cornerstone Macro and co-founder at the firm.